It does seem to me as you're among the dollar bears out there, and I just wonder whether there's anything in this inflation print due later today that could change your view and thereby change your view of emerging markets.
At the moment, the forces on the dollar are that you are still seeing a deterioration in the trade deficit, you're still seeing the fiscal position deteriorate, and you're also seeing real interest rates on dollar deposits going further and further into negative territory. So at the short end of the yield curve, the T-bills are going close to zero. And as you alluded to in your earlier report, core CPI is likely to accelerate through the April-May period. So the reality is that the support for the dollar in relative terms is actually very, very weak. I think the only piece of good news really is potentially out there over the next couple of weeks is that President Biden will probably announce that by and largely the pandemic is over as the number of hospitalization cases continue to fall. But again, currencies are a relative game, and it's better news coming from places like Italy and Europe, and also, of course, in some of the trade data that we're seeing in North Asia at the moment.
Yes, and as you say, I mean, it's a relative game here, but also the vaccine success in the U.S., the success in the pandemic right now may raise more objections from the Republicans as to the final amount that we need on the budget plans here. I mean, I think they may say, well, wait a minute, if things have improved so much, does it warrant this huge trillion-dollar figure that you're touting, multiple trillions in some cases? So to that extent, I mean, how does that fiscal versus the monetary policy expectation debate play out in your expectations of where we head for the dollar?
Well, I think the way you framed it is very, very, very good, because this particular cycle has seen a fusion between monetary and fiscal policy, which has created a very large nominal GDP growth number for this year and for next. You're looking at something north of 9% of nominal GDP growth this year, and that's very much a philosophy of when you are fighting a war, which is exactly how the US has dealt with COVID-19. There are two issues now that are appearing on the horizon outside of the saying that the pandemic is over. One is that once you mention those words, the market will naturally assume that we're going to have tapering very shortly afterwards, which is not necessarily going to be great for financial assets, given the correlation between the S&P and the balance sheet of the Fed. And secondly, it's going to make life much harder to get those fiscal initiatives through Congress. So looking further out now, I think the equity markets are going to have to live through a much lower rate of earnings growth expectations for 2022 than the massive turnaround that we've seen in the last 12 months.